Hello and welcome to Sustainability Uncovered from Edie, the podcast for anyone working in or passionate about sustainability and climate action. Coming up in today's episode, which is all about climate risk. These two words have gone from the back pages of annual reports to the front of board agendas in the space of just a few years. But what does climate risk actually mean for banks, for insurers, and for the businesses that depend on them? And what happens when the land itself starts to fail? A new framework, SS525, which was first published by the UK Prudential Regulation Authority, or PRA, in December 2025, aims to help the financial sector better capture and quantify these risks. First up, Weightmans breaks down what makes the framework different from past guidance and the importance of nailing down a climate risk strategy.
The organizations that adopt most successfully will be those where sustainability, finance, and risk teams work together to build a consistent narrative about long-term business resilience.
Then, UK Finance provides an overarching look at the framework from the financial world perspective.
The regulation doesn't allow for this just to be a compliance exercise because the regulation sets expectations that firms will embed climate risk into their governance and into their strategy.
All of that and more in this episode of Sustainability Uncovered. Hello and welcome along to Sustainability Uncovered, hosted by Edie, the UK's longest running business-to-business media brand focused on all things environmental sustainability. So we're just coming up to the end of August 2026 and you're listening to the voice of Edie's acting content editor, Matilda. So I'm back in the studio again and joined today by our editor, Matt.
Hello.
So we were here not that long ago, so I don't know that there's too much to update on, but how are things going?
Oh, there's always stuff to update on in the climate space. It feels like every day something's hit the national headlines. Yeah, often bad. Although I did see today the statistics about ULEZ reducing lung cancer amongst young children, which was positive. Yeah, it's always busy. I think from an ED side, it's more just kind of August is still the quieter month in terms of not too many events to go to, not hosting too much ourselves. People are on school holidays and holidays with their family. So we've just been building up strategy stuff ready for basically September till end of year is just going to be a mad blur of climate conferences and our own supply chains events and various other summits to attend. So it's kind of the calm before the climate storm, not a physical climate storm, which is
potentially
hopefully.
Well, speaking of climate storms, I mean, luckily the weather has eased up and we saw rain for like the first time in 3 months.
I'm always fascinated by like how ancient civilizations like kind of came up with gods and stuff, but when you see rain for the first time in 4 months, it's quite easy to go, what is this strange thing in the sky, and should I pray for more of it? So it's good that it's finally here. I think it's here for a week or so, and then the Met Office is already saying that September could bring another heat wave our way. So this feels more like the English summer. I think we've been accustomed to over the years. Rain and sun clashing.
We're more comfortable with this than the 37 degrees. Well, I'm kind of choosing to ignore the fact that, is it the 6th heat wave?
Yeah, 6th I think it'd be.
Yeah, is incoming. But regardless, we're talking about climate risk today. It's a pretty broad term, but could you explain kind of what climate risk actually is and what it means for businesses in a practical sense?
And risk kind of takes on many forms, but essentially it is the kind of exposure that organisations face because climate change is happening. And it's often split into kind of various categories. There's obviously physical risk, which I think has often been the kind of focus on climate change, which is why organisations haven't necessarily acted on it. It's like, well, it's not a risk to us yet. Our operations aren't going to be flooded, or we're not going to suffer from drought, or our supply, probably more so than supply chains, it was a concern and a place of action. But we've seen that in the UK. You look at the kind of farming sector and crop outputs this year. So the value of assets and the physical risk to operations and supply chains is one area. You also kind of have that obviously transitional risk, which is how your company can perform economically as sectors shift away from business as usual approaches to more kind of climate resilient approaches. easy one being automotive. You look at an automotive manufacturer. How is your business going to perform if you aren't producing electric vehicles? When the market is transitioning to EVs, you're going to make a loss. And then there is the obviously financial risk that comes with it, just loss of business as new regulations come in and consumer behaviour shift. There's also stranded asset risks as well, to that EV kind of anecdote. If you're investing in traditional ICE combustion vehicles, those are stranded assets further down the line, although I say further down the line, we keep pushing the ZEV mandate back, so maybe not so. And then, there's also reputational risks associated with this, certainly amongst the younger generation as well. So it all kind of pulls in there, but it's not just a case of my operations are fine, my business is fine. There's lots of things to consider.
Yeah, and in terms of how businesses kind of approach different climate risks and different risks more broadly, we've got a new series that I think the first edition went out a couple of days ago or a few days ago when people are listening to this, and that's the boardroom briefings. So Matt, you authored the first one, so do you want to give a bit of an overview?
Yeah, I think this is breaking down context that I think a lot of our audience will be aware of, but the wider business might not. I think people know what water scarcity is. It's a bit like Romsor, right? It's on what it is on the tin. It's just scarcity of water. But translating that into business actions and building resiliency, I think is less tangible at the moment. So we basically pulled all our research, all the kind of organisations we lean on for content to build out these briefings that break down jargon. So it's got this first one, which is focused on water, building business case for water, features definitions of WASH, water stress, water scarcity, global water bankruptcy, which is a brand new, not at all alarming term, and what those can mean for businesses. So it kind of outlines a lot of context around financial losses associated with water and drought and the increasing likelihood of that happening, but also the business opportunities that come with acting. And to those categories I mentioned of risk, if you just flip those on your head and acting on those are the opportunities. You protect your operations or your supply chains from drought with better kind of approaches to water reuse or recycling. The transitional risk means that you are less exposed to volatile commodity prices when drought dries up certain crops. A reputational boost for being able to see as a steward of the community by protecting watersheds. So it all kind of comes full circle in that sense. So these briefings are very much designed to, I think, break down context that we know and kind of outline, well, this is the business value of it in a succinct way. And I think on the water aspect, the one thing that stood out to me was that for every dollar or so spent in water, and it's not kind of just a dollar, this was like a multi-million pound kind of overview of it. But for every £1 million spent, for example, there was a £6 million return. So 6-in-1 return to act on water now, which is something, if you're sitting there listening and your board just isn't paying attention to this right now, that's a way to get them to listen.
Yeah, absolutely. Well, if you haven't seen that already, that's up now on edie.net. Keeping the tone jolly, I've got a quiz on the climate crisis and climate change impact and desertification, because obviously the desertification COP17 is now underway, which we'll talk about a bit later. But yeah, no, I've got some questions to fire at you, Matt. So I hope you've been revising and studying the edie library. I
haven't, but the good news is City isn't here, so I can't lose.
That's so true.
So I've already won just by being here.
Just by coming into the office.
just by being part of the podcast, I am the winner. So
perfect.
The best type of winning is by default.
Yeah. It's very noble. So first one, what percentage of UK businesses were hit by climate-related revenue loss in the last year?
I think I actually wrote about this not too long ago. I want to say it was either like 1 in 12 or 1 in 5. I'll go 1 in 5, so 20%.
No, it's actually 70%.
70%, not 1 in 12 at all.
Yeah. Close enough. I think it might have been 1 in 12 for if it severely affected
I
their
think
bottom line.
City would have guessed 1 in 12, so by going for the high number, I've won.
Okay, perfect. Next one, so we're going on to desertification. What percentage of the world's land surface is currently considered dry land and therefore vulnerable to desertification?
Of the world's land?
The land surface,
surface, yeah, okay. I will say 55%.
It's close, it's 40%.
40%, okay.
So it's not as bad as...
No.
Yeah, being pessimistic.
Yeah.
Very good.
No need for a COP, really.
Yeah, exactly, everything's fine. How many people experience severe water insecurity at least 1 month a year?
How many people just in the world?
Yep.
Okay.
Yeah. To the nearest billion.
To the nearest billion experience.
Severe water insecurity for at least 1 month a year.
How many people to the nearest billion? I mean, you could ask how many billion people in the world, and I wouldn't know the answer to that. I would say 5.
Bit lower.
3.
Bit higher.
4.
Yeah.
Yeah.
Exactly right.
We'll just edit that to make it sound
Yeah.
like the first time answer.
Oh, these are all just quite bleak, aren't they? What percentage of England, or what fraction of England, is currently in drought?
2/3. I do know that one.
Yeah. Although after the rain today, who knows?
Well,
maybe
yeah.
it's.
Well, there'll be floods next, won't it? Extra dry land with increased rainfall.
You just can't win. Which country hosted the first UNCCD, so the first desertification COP back in 1997?
Ooh, that is a good question, and one I have no clue. I'm going to go with Brazil.
No, it's in Europe.
In Europe? Okay.
Yeah.
Spain.
No, Italy.
Italy, okay.
Yeah, it was in Rome.
Hmm.
Which is a lovely venue for the,
I
for
did
the
know
first
that.
COP.
Yeah, okay, I did know that, yeah.
Okay, and final question. What is the funding gap between what's needed to build global drought resilience and what's currently being spent?
Global drought resilience needed and spent 530 billion.
278 billion.
Oh, there you go, less than half what I said.
Yeah, so
No excuse to not get on with this.
it's
That was
pennies.
a super fun quiz. Very, very kind of bleak,
I'm
and also
impressed.
exposed me as not knowing anything about drought. So
Oh, but now you've learned so much.
yeah, but still won the quiz. So
Yeah,
I'm
exactly.
sure
Congratulations.
listeners have done much better than me. But yeah,
Yeah. So all of those questions show that climate change, it's not a future problem. It's very much already here, and it's only becoming more and more expensive for the world and for businesses, especially when they don't prepare properly. And this is where the SS525 comes in. So it's the PRA's new supervisory statement on climate-related financial risks for banks and insurers. And obviously that's a sector that's really exposed to the climate impacts that are going on across the world. So SS525 came into force this year, and the June deadline for regulated firms to complete their internal gap analyses has now passed. So this is a live operational issue. It's not just a theoretical one. To get a better idea of what this framework means, I sat down with Abhay Srivastava and Aidan Thomson from law firm Weightmans. Here is that conversation now in full. So hi Abhay, hi Aidan. Thanks very much again for joining today's episode. Before we jump into the bulk of the conversation, if I could just get each of you to introduce yourselves and your role at Weightmans. So Aidan, if I come to you first.
Yes, thanks very much, Matilda. I'm Aidan Thomson. I'm a partner specialising in environmental regulation and liability matters at Weightmans.
Thank you, Matilda. Hi everyone, my name is Abhay Srivastava. I work as partner and head of ESG at Weightmans.
Okay, perfect. And for this first question, Aidan, I'll come back to you. So we're talking all about SS525 today, and the new framework has been described as a step change rather than a refinement. So what do you think is the most important thing that people need to understand about what has changed from the previous framework?
Well, the biggest change is that climate risk is now being treated as a core financial and prudential risk rather than just an ESG or sustainability issue that sits, around the periphery of the business. I think under the previous regime, many firms focused heavily on disclosures, policies and high-level climate strategies, but SS525 really raises the bar significantly. The PRA is now asking organisations to demonstrate how climate risk influences actual business decisions, from underwriting and pricing right the way through to capital allocation, reserving, investment decisions and strategic planning. So in simple terms, I suppose the question has moved on from do you understand climate risk to can you prove that climate risk is actually influencing your decision making? And the firms that succeed are those that can evidence a clear link between climate risk assessments, board discussions, risk appetite, management actions and business outcomes. That's why I think that SS525 represents a real step change. It's not just asking firms to do more reporting, more detailed reporting. It's asking them to operate differently.
Yeah, so it's about, making that data really actionable rather than just, as you said, continuing on the endless reporting train as many businesses have been on. In terms of what you've been seeing with clients, how ready do you think firms were for the June deadline? And what have been maybe some of the most common gaps you've seen?
Okay, well, the picture predictably has been mixed. Most firms had undertaken some form of gap analysis and were able to demonstrate some progress, but very few, if any, would claim to have reached full maturity in relation to the PR expectations by the June deadline. I think the most common gap we've seen, Abhay and I, is around embedding. Many organisations have developed climate risk frameworks, but the evidence trail showing how climate risks are actually followed through and affect day-to-day decisions is often less mature. I suppose, boiling it down, we've observed three recurring challenges. The first is data quality and availability. Firms often know what climate-related data gaps exist, but haven't yet developed a clear roadmap for addressing them. And second is governance and accountability. While boards are generally engaged with climate, many firms are still developing the competencies needed to challenge management effectively on climate-related risks. And the third is scenario analysis. A lot of organisations have run climate scenarios, but fewer have demonstrated how those outputs are actually influencing strategy, risk appetite, or capital planning. I think the strongest performers are the ones that are ready to move beyond identifying gaps and clearly specify the ownership, investment requirements, timelines, and measurable outcomes. The regulators are increasingly focused on execution rather than the initial diagnosis stage.
And jumping onto what you mentioned first, so those data gaps are obviously a huge issue, but accessing the physical risk data it's often, really inconsistent. It can be really expensive and inaccessible for some firms, particularly those that are resource constrained and people constrained. So, Abhay, what would be some of your practical advice to firms that are constrained in terms of plugging those gaps?
Thanks, Matilda. That's a very good question. And my advice, based on working in the sector for over a decade, would be not to let perfect become the enemy of good. The PRA recognizes that climate data is still evolving and that not every firm will have access to sophisticated data sheets. What matters is whether the firm understands its material exposures, documents its assumptions, and is transparent about limitations. A practical approach here would be to start with the risks that matter most. So rather than trying to acquire every available data set, focus on business critical exposures is the key. And I can give you some examples, like insurers might prioritize flood, heat, or storm related exposures in specific portfolios, whereas banks may want to focus on sectors facing significant transition risk or highly exposed collateral locations. It's also important to create a structured data improvement roadmap because regulators will generally be more comfortable with imperfect data if there is a credible and evidence-based plan to improve it over time. So in my opinion, ultimately the objective isn't to achieve data perfection overnight. It's to demonstrate that decisions are being made using the best available information and that the quality of information will be improved year on year.
Yeah, as you said, it's progress, not perfection, but every little counts, and those small improvements over time will make a huge difference in terms of overall business resilience. Something that Aidan's already kind of alluded to at the start is that SS525 is about really embedding climate risk in decision making, in governance. It's not just about reporting. So instead of it being delegated to a sustainability team and kind of being siloed, now it's sitting within the existing governance frameworks. In practice, what does it mean for a board to genuinely kind of own the climate risk rather than just sort of receiving periodic updates from the sustainability team?
Thanks, Matilda. For me, board ownership starts when climate risk becomes part of mainstream governance. rather than a standalone ESG agenda item. A board genuinely owns climate risk when it is actively considering how climate-related developments could affect profitability, solvency, operational resilience, and long-term strategy. That means climate risk should be reflected in risk appetite statements, board papers, investment decisions, so to say, product development discussions, and strategic planning exercises. It also means directors must have enough knowledge as well as confidence to challenge management inputs. Receiving quarterly updates from a sustainability team is not the same as exercising oversight. And one of the most interesting aspects of SS 525 is its emphasis on competence. Boards need access to the right expertise and training so that they can interrogate assumptions, understand climate scenarios, and make informed decisions. This is ultimately a governance issue, not at all a sustainability issue. And the test I often use is this. If the sustainability function disappeared tomorrow, would climate risk still be discussed, monitored, and managed through existing risk and governance structures? And if the answer is yes, then climate risk is probably embedded into the organization.
And Aidan, coming back to you, obviously there's the compliance side when it comes to getting SS 525 right, which is hugely important for firms. But are there business cases kind of outside of the regulatory compliance angle?
Yes, well, absolutely. I think there are. And the first benefit, I would say, is resilience. I think organizations that understand climate-related risks are generally better positioned to anticipate market shifts and sort of supply chain disruptions, physical climate impacts, and changing customer expectations. And simple as that. But the second business case is access to capital and insurance. Investors, lenders, and insurers increasingly expect robust climate risk management. Remember, a lot of those will be subject to SS 525 themselves. Firms that can demonstrate a strong governance, credible data, and forward-looking risk management are often viewed as lower risk counterparties. And looking on the flip side, where insurers and lenders identify heightened climate-related risks, they may do things like increase premiums or change coverage criteria or limits or require mitigation measures before entering into arrangements. And there's also, most importantly, there's a commercial opportunity. Climate transition is creating demand for new products, new services, and business models across every sector. I think organizations that understand these trends early are often much better placed to capture the growth opportunities. And perhaps most importantly, SS 525 encourages better decision making. When organizations integrate climate-related considerations into strategic and financial planning, they gain a more comprehensive understanding of the risks and opportunities likely to affect long-term value creation. So while the regulation is often viewed through a compliance lens, I think the organizations that will derive the greatest value from it are treating it as a strategic business exercise rather than simply a regulatory project.
Absolutely. And you mentioned that kind of cross-sector impacts there. Obviously, the regulation has ripple effects. It's not just, the financial sector. It extends to every business that kind of borrows, insures or raises capital in the UK. So, Abhay, I'll come to you for this one. What's one thing that a sustainability professional at a large UK corporate, for instance, should do differently because of SS 525, even if they're not themselves kind of impacted by the regulation?
Thanks, Matilda. There are multiple aspects to that question. And one thing that I would recommend is to start collaborating with finance and risk functions to present sustainability information in financial risk language. And there is a good reason for that. So historically, sustainability teams have focused on carbon emissions, carbon targets, reporting frameworks, and broader sustainability objectives. Those remain important, but with SS 525, the investors and insurers would want to understand financial implications of these considerations. They would want to know how climate change could affect revenue, costs, asset values, supply chain resilience, and for the UK corporates they lend to, insure, or invest in. Businesses may find that their lenders and insurers increasingly request information such as greenhouse gas emissions data, net zero commitments, transition plans, climate-related targets, physical climate risk exposure such as flooding, overheating, water stress, etc., and supply chain resilience information. This is because insurers and banks need sufficient data to identify and assess climate-related risks within their portfolios and risk management frameworks in order to meet expectations described in SS 525. The PRA highlights litigation and greenwashing risk as important considerations as well. So insurers and banks are expected to consider the possibility of claims arising from misleading sustainability commitments or climate-related representations. So this could indirectly encourage sustainability professionals in these businesses to improve governance around sustainability claims, themselves verify environmental statements, strengthen disclosure controls, and avoid any unsupported net zero or carbon neutrality claims. The organizations that adopt most successfully will be those where sustainability, finance, and risk teams work together to build a consistent narrative about long-term business resilience. And such businesses would be able to demonstrate good governance, credible transition plans, climate resilience, and have robust environmental data in place. And they may find it easier to access funding, insurance, and investment. In many ways, that is the broader significance of SS 525. It is indeed accelerating the integration of sustainability and financial decision making across the entire UK economy, not just within the regulated banks and insurers.
Okay, thank you. So it's not just about the reporting, it's about getting it embedded, and the more it's embedded, the more resilient companies kind of across sectors are going to become. Absolutely. Well, I think that's all we've got time for today, but thank you both so much for joining the podcast and on the topic of climate risk and resilience with another, I think it's 36-degree day due this week in London. I hope you both are someone with a good fan or aircon.
Thank you.
Thank you, Matilda.
Yes.
A big thank you again to Abhay and Aidan for their time. We're going to take a really short break now, but don't go anywhere because next up we'll be talking with Ian Bhullar, the Director of Sustainability Policy at UK Finance. Hello and welcome back to the Sustainability Uncovered podcast with me, Matilda, and Matt. Now we've heard from the legal side, but obviously it's the financial institutions that need to put SS 525 and climate risk mitigation into action. To get their perspective, City sat down with Ian Bhullar from UK Finance, which is the collective trade association for the UK's banking and financial services sector. So here is that interview now in full.
Hi Ian, welcome to Edie's podcast. How are you doing?
Thanks, Edie. Nice to meet you. I'm doing well. How are you?
No, well as well, thank you. The topic that we're talking about today is quite interesting, SS 525. I have always struggled with financial jargon and, all the different policies that we get in this space. So I guess just for my benefit and the benefit of our audience, it'd be good to get a brief on what SS 525 really is and who it will be impacting.
Yeah, sure. SS 525 is the second supervisory statement that the Prudential Regulation Authority, which is one of the regulators for the financial services sector, particularly banks and insurers, has set out for those firms to take into account climate-related risk as part of the regulatory agenda. And you asked, who does it impact? The primary target is lenders, so banks and building societies, and also insurers. And UK Finance represents the banking and lender element of that.
Great. And from UK Finance vantage point across the membership, is the banking sector generally in a good place with climate risk? And where are the gaps that SS 525 is designed to close?
The first thing I'd say is the banking sector is probably one of the most heavily regulated sectors within the UK economy in terms of thinking about and managing climate-related risk. And there are reasons for that. And one of them is that the financial services sector is already quite heavily regulated to ensure that it is considering long-term impacts to its resilience arising from systemic change to the economy. And what SS 525 does is ask firms to think about how they're embedding climate-related risk into that wider financial stability and resilience agenda. And the reason for that financial stability and resilience agenda is because the banking sector is a systemically important sector for the UK economy, and partly due to things like the financial crash of 2007 to 2008, there's been a huge amount of regulatory intervention in the intervening sort of decade and more to ensure that banks are resilient and are protecting the wider economy. The sector has already been subject to quite a lot of regulation in this space. So, as I said, this is the second supervisory statement from the Prudential Regulation Authority on this issue. The original was SS 319 in 2019, which initially sought to set expectations for lenders and insurers to think about climate risk as part of their wider resilience. The PRA also ran what it called the Climate Biennial Exploratory Scenario in 2021, where it asked major lenders to examine a series of climate-related scenarios, both transition risks, so what does the future transition to a low-carbon economy look like, but also physical risks of climate change, and asked how does that impact the resilience of our businesses. As a result of all of that, to answer your question, the sector is generally quite well set up in terms of expertise and resourcing to be thinking about and to be embedding climate-related risk into business practices. And there are great initiatives out there like the Climate Financial Risk Forum, which was set up by the PRA and the other financial services regulator, the Financial Conduct Authority, to help firms share best practice in how they manage and approach climate-related risk. You asked about whether the sector is in a good place on climate risk and what are the gaps that SS 525 is designed to close. Helpfully, the PRA was very explicit when it issued SS 525 and in the intervening years since 2019 about where it saw some of those gaps and why it felt SS 525, the renewal of the supervisory expectations, was important. And it issued 3 letters to financial services chief executives and chief financial officers asking for additions and developments in practice that would build on what they were already doing. And it pointed to things like the fact that there was a need for better embedding of climate risk into governance and strategy, for firms to improve the way that they measure and model climate risk and how they approach what's called scenario analysis, so looking at specific climate scenarios and examining how those affect the business. So we know for a fact what some of the issues that the PRA was looking to address in SS 525 were. We also at UK Finance undertook a benchmarking exercise a couple of months ago to hear from our members where they thought their gaps and capabilities were. And what we heard from that in general was firms tended to express that they were more confident in having embedded climate considerations into governance, so improving in making sure that their boards were aware of and understood climate risk. They also said that in general they had stronger practices in public disclosure, and that's partly because the sector has a long history now of disclosure on climate-related metrics through things like the Task Force on Climate-Related Financial Disclosures. Where they said that they needed further work was in more complex areas like climate scenario analysis, so what I said earlier about actually mapping out how some scenarios play through, and data collection. And data is always a really tricky one because of the ways that the financial services sector is exposed to climate risk is often through their clients, and so need data from clients within their portfolio.
It could not be more timely scenario analysis, because I remember reading a report from the Institute Faculty of Actuaries earlier this year called Planetary Solvency that highlighted that there's a big gap in how climate risks are being mapped and then integrated into policies, but then also how banks and businesses in general are thinking about climate risk. So that is really interesting. But just on regulation, there's this feeling in the sector that regulation often turns into a compliance exercise rather than an actual strategic shift. So what has been the kind of reaction from your UK Finance members to these new expectations?
Yeah, I'll give a cheeky answer to this, which is that I think the regulation doesn't allow for this just to be a compliance exercise, because the regulation sets expectations that firms will embed climate risk into their governance and into their strategy. So it has to be a strategic shift by nature of the way that the regulation is framed. And to give a few examples of that, SS 525, building on SS 319, requires that lender and insurer boards are educated and understand climate-related risk and are part of the decision-making process in setting the strategy for the business as to how it manages that risk. I think it's important to say that it is generally easier for larger firms to fulfill those expectations, and it's quite important to make a distinction here between different sizes of firm. If you're a large firm that was involved in the climate biennial exploratory scenario a few years ago, you'll have built up a lot of expertise, you'll have more resourcing to throw at understanding and addressing climate-related risk. Even for them, it's still tricky, right? And I talked about data availability and all that stuff. It's even harder often for some smaller financial services firms. And I'm thinking of sort of an example of this might be, for example, a smaller regional building society, because they need to be on top of this alongside a range of other regulatory requirements, whether climate or not, and things like making sure their boards, who have limited time, are knowledgeable and able to opine confidently on things like climate risk is a bit of a lift. And for teams that don't have a dedicated climate risk expert but are trying to do climate related risk as part of their wider risk activities, there's a much bigger lift on things like climate scenario analysis. Just to give an example, I mean, I was at the Exeter Climate Conference a couple of weeks ago, and that was a fantastic conference, you know, bringing together climate scientists and practitioners from across industry. And what I took away from that is that climate scenarios are hard enough for experts, climate scientists, to communicate and to understand the diversity of different outcomes that might come from given inputs. So for bankers or risk professionals within the banking sector who don't necessarily, well, certainly may not have an academic background in climate science, to get their heads around this and to apply it to their businesses is naturally complex. But there's a lot of supportive environment around this, right? So there's a growing ecosystem of third-party service providers. There's lots of support through things like the Climate Financial Risk Forum, which is really helpful. But one of our main calls to the PRA when they rolled out the expectations was, please do support and give space to those smaller lenders to get up to speed with the requirements and improve their practices over time.
Can I talk about banks and climate without addressing the elephant in the room, which is fossil fuel financing? SS 525 explicitly replaces SS 319 to move from a high-level climate awareness to actionable, board-approved risk limits. Will this be impacting the way banks lend money, and what would this mean for fossil fuel financing?
The first thing to say is, just to be really clear, the policy intention behind SS 525 isn't to influence lending decisions. And I want to make that clear just so that there's a kind of common understanding of what the intention is. The intention behind SS 525 is to ensure that banks and other financial services firms are embedding climate risk considerations into their long-term resilience, both financial and operational resilience. Any influence on lending decisions would be a secondary impact and potentially an unintended impact. I'll say two other things. The first is that there is a plausible mechanism through which the requirements of SS 525 may influence decisions about fossil fuel financing, and that's an assessment of transition risk and policy. Essentially, one of the things that SS 525 asks firms to do is to examine not just climate physical risks, but also transition risks, and to look at how a changing economy, as a result of the drive to a lower carbon economy, might create new risks or opportunities for lenders. And so if you are a lender that operates within a jurisdiction like the UK, which has pretty ambitious climate policies, and you're currently exposed to fossil fuels, either through demand or supply, you might consider that there is a heightened risk arising from a changing policy environment that might disincentivize your lending to oil and gas companies in the future. It's not driven by SS 525, but it's driven by an assessment of the policy environment. But the important thing to say is that that relies on having an ambitious policy environment that actually drives the economy as a whole toward a lower carbon energy system. So that's sort of the causal mechanism that I see between SS 525, climate risk assessment, and fossil fuel financing. The other thing I'd say is that SS 525 isn't the only regulatory intervention and isn't the only activity in the financial services world on climate change. And of course, one of the other things that we have in parallel are decarbonisation commitments and transition planning. As you all know, a lot of financial services firms, particularly in the UK, made decarbonisation commitments several years ago. Many continue to make them. And as part of those decarbonisation commitments, they'll often have either explicit policies on fossil fuel financing, or they'll have transition finance policies that will partly look to phase out elements of their fossil fuel financing. So there is an enormous amount of work going on in this space, right, to support changes to the way that the financial services sector finances oil and gas and the fossil fuel sector more broadly. But I would say that SS525 isn't the main mechanism for that change, and if it is at all, is only part of the puzzle.
I was wondering what the new policy would mean for UK corporate that's trying to seek finance.
So increasing regulatory scrutiny of lenders' climate risk exposures by necessity means that in order for them to be confident about what they're telling the regulator, they need to have access to more data and better data on what their climate-related exposures look like. That means building often a more holistic view of their clients' business models. So that might mean things like understanding what assets they have in climate-exposed regions. Are you exposed to increased risk of flooding? Are you exposed to increased risk of wildfire, to use a timely example? Understanding which sectors have greater exposure to climate risk, and also looking at transition risk and how companies are preparing for different future scenarios toward a lower carbon economy. A lot of that is really challenging to get, particularly if you're a lender that has exposure to lots of SMEs. So you're going to need to ask for data and information from a lot of different companies. It's important to say that SS525, again, is coming alongside a lot of other regulation and comes after a lot of other regulation in this space. So some of that's already out there. And if you think about the fact that the Task Force on Climate-Related Financial Disclosures expectations came into play now 5, 6, maybe even more years ago, a lot of companies have already been disclosing against those. We're expecting the FCA to issue new disclosure requirements aligned with the UK sustainability reporting standards shortly, and the government is also considering how it will revise its disclosure expectations against the UK SRS. So there's already a lot of data out there, and there's a lot of requirement already for corporates and businesses to report on some of their climate-related activity and exposure. The expectation in SS525 is that banks have a real grip on that data and understand it well, and therefore it may mean that they might seek more assurance over that data. But I think it's also important to say that banks and we are really mindful of the fact that there's always a risk of overburden on bank clients and customers in terms of data provision. So there are lots of initiatives out there that are looking to kind of streamline and simplify the process of getting access to that data. There are lots of private initiatives, third-party vendors that use things like AI-enabled data scraping to help collect as much SME data as possible so that the SMEs themselves aren't having to fulfill lots of data requests. And there are initiatives like things that we've been involved in, like the Bankers for Net Zero Broadway initiative, voluntary standard for SME data collection, which looks to simplify the process of data collection across the piece and reduce that burden on SMEs.
Fortunately, this is all the time that we have for this segment. So thank you so much, Ian, for joining the conversation. And I hope some of these insights will be helpful for our audience listening. So thank you so much. And thank you so much for being on the podcast.
Thanks very much, Izzy. A pleasure talking to you.
Thanks to Ian once again for his time, and that brings our guest interviews for today's episode to an end. As we mentioned in past episodes, we're in the midst of a triple COP year, so very exciting in the world of sustainability, and the first of which, as we mentioned, has just started, and that's the desertification COP, or the UNCCD, so another acronym. So that started on the 17th of August and that goes on until the 28th, and it's happening in Mongolia. For listeners that don't know what desertification means, that's where productive land becomes degraded and eventually it becomes barren, and that's driven by a combination of climate change, overgrazing, deforestation, and then other unsustainable land use from humans. And the reason why Mongolia is particularly kind of relevant for the location of this COP is because it's one of the countries that's most severely affected by desertification. So particularly for companies in the UK, desertification can feel like a really abstract idea, although when you look around the parks at the moment, they all look so dead and so dry, so maybe it doesn't feel as far away as it would have done in other years. But what does the desertification COP mean for businesses, and why should businesses care about what's going on?
Yeah, I think it's one of those aspects, a bit like water, where it feels obvious that we're dependent on land, but it doesn't necessarily feel obvious as to how. And I imagine if anyone listening now just looked around them, whether they're sitting at their desk on the commute or out walking as they listen, you will probably find something within touching distance that is basically dependent on land and ecosystem management, whether that's wood for the table that you're sitting at, fibres, and in particular agricultural commodities that we rely on. So the supply chain aspect of this is obviously quite severe, and more than half of the world's GDP is essentially at risk from nature loss, which desertification plays into. I think that was PwC that said that. And for the UK economy, that can be, I think, a shrink of up to 5% by 2030 due to kind of degradation. So private sector commitments and action to essentially be stewards of the land isn't going to solve those big numbers. But what it will do is position you for when and if legislation inevitably does come. That's what tends to happen at COPs. You get these big global agreements and frameworks that come in place, and then a year or two down the line they tend to trickle down into national or regional policies. So what is said about land management in Mongolia could well make its way into the political space, perhaps not in the UK, but certainly from within some of the countries that our businesses source from as well. And if it doesn't come into the UK political space, there's a good chance that business advocacy could well make it. So there's a chance out there for organisations, and I think Business for Land is the kind of big one out there in terms of getting companies to set targets and disclose their impacts on land, soil and water, and use finance as a mechanism to promote restoration and resilience and regeneration, which are all free terms that corporates absolutely love talking about right now. It's for the free talk. This is the free terms they're more than happy to talk about. Everyone else has gone quiet about it, but regeneration, that's the kind of buzzword. So it does have material impacts on supply chains. It'll be cost volatility aspects as well, and it's a case of move now before it's too late, essentially.
Yeah. I mean, we're a bit too early on in the process for any kind of concrete outputs yet from the COP, although that could change by the time this podcast is out. But obviously we'll be, if there is anything major that comes out before the end of the COP, we'll be covering that on edie, and we'll be publishing a roundup of the negotiations as and when they come. The next COP coming up, which is the biodiversity COP, isn't until October, but obviously that's kind of really intertwined with all of the discussions that are happening at the moment in Mongolia, because obviously the desertification COP, that is kind of underpinned by the 30 by 30 goal, so restoring 30% of degraded land by 2030, and healthy land and healthy soils obviously underpin not marine biodiversity but all other biodiversity on the planet. So on the topic of biodiversity and nature, next month's episode will be discussing bio-based materials and building with nature. But in the meantime, Matt, is there anything else that you want to flag that's going on in the next few weeks?
I don't think in the next few weeks, no. Like I said, it's our next big event is supply chains, which is topical, on the 17th of September. So we're kind of building up to that at the moment, and we've got a few EU virtual events that we'll be hosting after that, getting to grips with all the climate legislation that's coming down the road there. We had the packaging and packaging waste regulations coming last week. Green Claims Directive is 5 weeks away, probably 4 by the time people are listening to this as well. So we're going to be doing a big piece on that as well. So it's getting to grips with these policy aspects in the EU and how that's going to shape UK markets and approaches as a result.
Okay, perfect. Plenty to look forward to in the next few weeks. So yeah, make sure that you're subscribed wherever you normally get your podcasts, and keep checking edie for any updates on this desertification COP. But for today, it's a goodbye from Matt.
Goodbye.
And a goodbye from me. Goodbye.